Hey, it's Lewis here and welcome back to the channel, and in today's video I'm going to be analysing Alibaba stock. I'll be using TIKR terminal to go through the financials, and then I'll be putting these numbers into my analysis checklist to ultimately decide if this business is of good enough quality for me to be interested in. After that, I'll put my free cash flow estimates into the DCF and we'll come to a fair value of their stock. Let's get straight into it. Who are Alibaba? So Alibaba Group Holding Limited, also known as Alibaba, is a Chinese multinational technology company specialising in e-commerce, retail, internet and technology. The company was founded in 1999 and it provides consumer to consumer, business to consumer, business to business, all sorts of stuff. So sales via web portals, electronic payment services through Alipay, shopping search engines, cloud computing, and it's got a big diverse portfolio of businesses in many different sectors. In 2014, they did an IPO on the New York Stock Exchange, and at the time it was the largest IPO in history, which is a fun fact for you. So yeah, the company itself is listed in New York via an ADR. It's also listed in Hong Kong as well, and it's one of the biggest companies in China. Now let's have a look at the sales per business for Alibaba, and we'll start with the sales per region actually first. All the sales are in China. Well, that's what it lists anyway, all the sales are in China, so there's no regionality with Alibaba, it's just a Chinese company. Sales per business, so this is a big breakdown here, but most of their business is China commerce retail with 66%. I won't go down the others because you can read them for yourself, but they've got sales in cloud computing, core commerce, digital entertainment, international commerce wholesale, that's like 2%. But yeah, you can see most of it's just e-commerce, but they've got bits and bobs everywhere as well, which are growing as as the business grows and then different segments develop. Now let's have a look at the Alibaba financials using TIKR terminal, and yeah, we'll start with the income statement to start with. So revenues from 2016 to 2021 have increased massively. You can see 30% year-on-year growth, and it's just been increasing over time. 2021 from 2020 was 41%, absolutely massive. So this company is growing at a massive rate. But yeah, what profit did it make as well? So gross profit increasing as well. It's not just growing revenue, but growing profit as well. Net income growing as well, very good. Interesting, 2021 wasn't much different to 2020. We'll see what plays out here, but the business itself is, profitable, and it's growing a lot as well at the same time. Right, so what shares outstanding have they got? So slightly increased over this period is what it is. It's obviously a negative, but with the amount of growth we've had, it's not a big deal really. You can stomach a small percentage of dilution. Right, onto the balance sheet now, and cash on hand has gone up massively over time, just a simple metric, which is a good thing. Long-term debt's gone up. As long as this is manageable, it's not too much of a big deal. Hopefully the free cash flow can pay it off within a few years, because that's what you want to see. Return earnings up massively, winner chicken dinner. Cash flow statement now, cash from operations minus capex is free cash flow, and you can see cash from operations is up massively and capex is up a fair bit, but free cash flow is massive. And just quick numbers in my head, quick maths, they can pay for debt off within a year or two, so simple stuff, very good. Right, they don't pay any dividends, buying back shares, I've done it a little bit but not much, so they're just growing the business, let's be honest, that's where their cash is going. Onto the ratios now. Why do I like ratios? It tells you a full story of a business, or a better story than just simple numbers on a sheet. Return on capital, not too bad, it could be better. You'd like to think when the company slows the growth a bit and they're not reinvesting into the business as much, this would skyrocket, but it's at a respectable amount now, but you want this to go up even more, let's be honest. Gross profit's down over the past 5 years or so, which is a concern, because you want this going up, but we will see. Net income margin has decreased a little bit. Maybe there's more competition now. Maybe they've been growing, they've had extra costs, but you want to see this figure not go much lower. You don't want it to continually go down because that will be a really bad sign. But free cash flow margin is still relatively high, so maybe it's just something to do with the accounting, which is making earnings look lower, but the free cash flow is looking a bit better. Current ratios are not much debt, a lot of liquidity. Cash conversion cycle is negative. This is what I was on about in previous videos. Negative cash conversion cycle is a really, really good sign for a business. It means they pay their invoices slower than they get the sales through the door. Debt to capital, so 14% debt to capital, so there's not much debt at all compared to the capital in the business, which is awesome. We can pay all the debt off very quickly. So yeah, they're the ratios, they're the financials for Alibaba. If you'd like to use TIKR Terminal, head over to the link in the description and you can sign up using my link. Let me know in the comments what you think of TIKR. I love it personally, and I think you'd like it too if you enjoy my videos. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions, you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger, and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you now there. Let's have a look at my genuine impact stats for Alibaba, and we'll start with the quality metrics first. So it's ranking high for quality, profitability is high, financial strength strong, capital allocation poor, which is interesting. But then going on to value, it's looking cheap currently on current valuations, income statement cheap, balance sheet cheap, cash flow very cheap. So we like that. We like companies to be cheap when we're buying them, so that's all good. Then on to the growth rates, it's just absolutely high growth across the board. No dividends here, but it's looking solid. I'm surprised the quality metric isn't higher because I think it's a high quality business myself. But it's interesting to see what the genuine impact stats have to say. Now let's have a look at my analysis checklist for Alibaba, and we will start with my first pillar. So profitable, high returns on capital using low leverage. So returns on capital are 10%, not quite the 15% I want. You want this to go up over time, and I think when Alibaba stops reinvesting in the business as much, this figure should go up. But yeah, you want this to be higher than 15%. So let's just see what happens with Alibaba in this one. Margins wise, smash out the park in terms of average margins. They have been decreasing over the past few years, but hopefully they can get back or maintain the margins, have it a bit more stable, because that's something that is important. You want stability in your margins, in your financials. Free cash flow margin is high though, which is a good sign. But like free cash flow you see on this channel, current ratio 1.7, lots of liquidity in the business. In terms of debt to capital, 14%, so not much debt at all in terms of the equity. Cash conversion cycle is negative as well, which shows it's a sign of a high quality business. Proven ability to grow across the board, growth in revenue, net income, retained earnings and free cash flow. Winner chicken dinner. Quick capital allocation, all red on this one for various reasons. They've been issuing debt, which is what it is, not too much of a big deal. Decreasing share count, have increased the shares slightly over the past 5 years. We've actually announced a big share buyback program, so we will see what happens with this. But I would expect their share count to go down massively over the coming years if the share price stays at current levels. Dividend growth, they don't pay a dividend because they're reinvesting into the business, so maybe a bit harsh, but it is what it is. Good acquisitions, we've had a few write-offs, so we'll see. It doesn't look like a material amount, but it goes red on the metric anyway. So this makes it look like the business is a bit crap really, but I would beg to differ personally. Quality score of 67%, mainly due to the return on capital and the capital allocation score in red. Right, buy at a fair price. So we need to buy at a fair price from when we are looking at stocks. So P ratio of 28, which is high, but with price free cash flow of 10. So the cash flow is looking very undervalued. It looks like the earnings have been reduced by some accounting number, likely, because free cash flow is a lot harder to manipulate using account adjustments. So 10 of price to free cash flow 10 is epic. Really good stuff. And DCF for a 10% return, I'm looking at 147 based on my conservative assumptions, current share price of $101 per share. That's a 45% uplift from current levels. So yeah, DCF anyway. On to DCF, hard to get to these figures. 3 years of free cash flow estimates from marketscreen.com, and then 2.5% revenue growth into the future. Extremely conservative for a company like Alibaba, but like I say, I keep the process the same for all of the companies I look at, just for consistency really, and margin of safety reasons as well, because I don't think you can predict 10 years into the future's free cash flow accurately. So I think 3 years is doable, 10 years I don't think it's doable, so that's why I do it. But anyway, share price, converting from yuan to US dollars for the USD ADR, $147 per share. So from current prices, like we've seen, it's looking like a good deal. I personally think it's high quality business. Return on capital can go up, then it's a win-winner. Margins are going up as well. So yeah, you just want to see the margins going up. Chinese stocks have been battered recently due to the market just not liking them, various reasons. But if the market sentiment changes, these are good quality businesses. I think they will over time get back to where they should be, a more fair valuation, because I don't think China's going anywhere, and some of these businesses are some of the best in the world. So there we have it. That was my full stock analysis for Alibaba, and if you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.